Hello, everyone. Mike Adams here, Stream Realty Partners. We are here for episode 5 of Adams Insights. As a quick reminder, we interview regional power players and people of influence. Today, we are actually really excited to have one of Stream's own. This is Thomas Galvin. He is the regional director of research. He has decades of experience in real estate analysis. His bio says that he can tell stories with numbers, and he's a specialist at real estate economic forecasting. Sounds to me more like he says he can tell the future. I don't know. So we'll see about that today. Actually, something really cool about Thomas is that he brews his own beer, and he gave everybody. Well, I don't know about everybody, so. I don't think he gave it to everybody, but people of importance within the office, some beer for Christmas, and it was delicious. So thanks for coming in, Thomas.
Oh, thank you. And the first prediction I'm going to make is St. Patrick's Day. I anticipate some tasty beer in the future.
Okay.
So just a little background about myself. I have 20 years of commercial real estate experience, entered the industry right out of grad school. I went to University of Nevada, Las Vegas. I got my master's in economics, studying game theory there. Right out of school, started into the commercial real estate field. That was 2004, 2005. Prior to that, I was getting my bachelor's in psychology at Cal Poly. So I am a person who studies human behavior and economics. So study of markets and how people kind of respond to that. So here at Stream, I am the Southwest Director of Research covering Southern California and Phoenix. And the people I've worked here have a long history of them, and it's good to be back. It kind of feels like, even though I'm here for the first time, it's a very familiar feeling. I've been covering real estate markets for 20 years, and the big thing was the great financial crisis, and here we are in 2023, kind of on the verge of another kind of big change. So
said simply, it's guys like Thomas that make guys and gals like myself look good. Oftentimes he's one of the brightest guys in the room. So that being said, maybe tell us a little bit about what brought you to Stream, why you at Stream.
Yes, so the reason I came to Stream is previous to Stream I was at Transwestern, and there it's more kind of a property management company, and some of the people I worked with at Stream I worked with previously at Colliers, and so kind of had that relationship here. And real estate's really all a relationship business, and they were willing to give me creative control to kind of publish the articles that interest me. And so I've written a lot about topics on the economy, such as employment, the interest rates, changes, inflation. So it's kind of an interesting time for someone like me, just because the last 15 years have been so boring. We've had 0% inflation, 0% interest rates, asset prices have only gone up, and in my experience, I've been basically writing the same market report for the last 20 years. Vacancy down, rents up, construction's up, and now that's all kind of changing.
So that dovetails into the next question. We talked a little bit about who you are and your credibility. Why didn't you tell us a little bit about what's going on in the Orange County marketplace?
Yep, so Orange County during COVID was one of the harder hit markets, mainly because a lot of our industries are tourism, which kind of took a big hit, but currently that's all changed. Everything that happened during the pandemic, now we're seeing the reverse. So before you had a lot of unemployment, you had a lot of unemployment benefits. Now that's all in reversal. So now the unemployment rate of Orange County is at a multi-decades low, and companies are still having trouble finding qualified employees. So that's going to translate into a tougher time for businesses, because they have to deal with wage inflation, finding people, labor turnover. So those companies that can hire good people, retain those people, and give those people the proper tools to work are going to benefit, whereas the other ones who are unable to change are going to suffer. So COVID has accelerated trends that were already in the marketplace, such as the rise of e-commerce and kind of the work from home trend that has really kind of taken off after the pandemic. So right now we are post pandemic essentially, in that how companies deal with getting back to normal is going to, that's kind of the motive for 2023, is everything's going to try to change back to how it was ish, but it's not going to quite be able to get there just because people have changed, the economy has changed, and it's going to be an interesting time for people like me who study those things.
So tell us a little bit about your predictions in short term. Is it like, are you going to see, will we see rent increases? Will we see rent decreases from a vacancy standpoint? Are we going to see a certain product type that will really perform substantially better? Is it, conversions? Tell us about what you foresee in the short term.
So the major drivers of the market, things that you read on in the market report, is vacancy rates, rental rates, construction, and currently there's a paradox where we're seeing a rise in the vacancy rate, but also a rise in the rental rate. So normally those two things are inversely related, where if there's a lot of space on the markets, landlords will kind of cut rates in order to attract more tenants and use that as a price stabilization method. But at an inflection point, the rental rate and the vacancy rate kind of go up, and that is because the Class A buildings, as that space becomes available, that kind of brings the asking rental rate to go up. So in the short term, we might see a bump in the rental rate going up and the vacancy rate kind of going up. A big part of the last year has been sublease space. A lot of companies put a bunch of sublease space onto the market, they took it off, and now that's kind of bleeding over to direct space. So there's going to be a slight uptick in vacancy, but most of the downside has already happened. Those companies that were struggling, they've already given back the space, and now it's just going to be kind of a slow adjustment period. So I don't see a big spike downward in rental rates. Rents are very sticky. In real terms, rents are kind of declining, because if you keep your rental rate the same over a year, even if inflation's going at 5%, 6%, and your rent doesn't change, you're still kind of losing money. Same thing with sales prices. So even if you keep your sales price the same over a whole year, in real terms, that sales price is slowing, or is starting to decrease. So we might see a continued standoff between buyers and sellers, a continued standoff between people looking to rent space and then the landlords. The biggest thing you can kind of compare it to is 2008. So in 2008, you had the delay and pray, you had the extend and pretend. Landlords had to keep tenants in those spaces and kind of massage deals. That is less likely to occur now, just because during the 2008 time period, you had inflation go down to basically zero. You had interest rates go back to basically zero, and you could refinance those buildings at a lower rate and kind of kick the can down the road. With a rising interest rate environment, it's a lot harder to kind of wait for conditions to occur. So once those buildings refinance, there's going to be increased pressure to kind of get stuff done. So don't anticipate things to happen like they did in 2008, essentially. So that's kind of my longer term prediction.
Delay and pray and
blend and extend.
So I've heard blend and extend.
Yep. So delay and pray, has to do with the financing of the building. A rolling loan carries no loss. This is where finance people can get a little punny. So during that time period, rather than foreclose on the building, the people who lent the money to the building owner, they don't want to manage the building. So a lot of these buildings, they could have gone into special servicing, and then in special servicing, essentially, they're kind of working out the kinks of the loan. During that time period of the last cycle, there wasn't a whole lot of distressed selling, and that's probably going to occur again this time too, just because once it goes into special servicing, they just manage the asset. They don't force the sale or anything like that. So.
Got it. So you're talking more the capital stack and the debt.
Yes.
You typically, when we use those terms, it's a tenant, right? So it's a blend and extend from like an early renewal and an extension of the lease. But I think you're right. I think probably and we'll see here. I mean, it's towards the end of January. You'll see a couple of trades on some Orange County office that will being rumored to close. Anywhere from the neighborhood of $150 a foot to $155 a foot. In call it Hutton Center, there's some stuff over in the South Coast Metro, $160 a foot, and even some stuff in Lakeshore. Just north of $200 a foot. All those had to feel pretty good from a basis standpoint. What do these trades, these lower trades, do to the market from a rental rate standpoint?
Yep, it offers price discovery, and the landlords are in at a much lower basis, so they have the ability to lower those rates. A lot of times, landlords need to keep the face rates high in order to meet their loan requirements. So in their pro forma, they basically said, these are the rates that we think we can get, and if the building is vacant, then it's marked to market. But now you're going to have to, lenders are going to be looking a lot more at in-place rents. So that's the rent that you're actually paid as opposed to the pro forma rent. And with a lower basis in the building, these landlords can compete on price to lease them up and then retrade the building once it's fully leased at a more reasonable cap rate.
So that's a question we get oftentimes from some of our tenant rep clients, like, hey, this rate that we're giving them, like the income is better than just leaving it vacant. You're saying it's better for these owners, the institutional owners, to have it vacant because they mark that to market?
Yeah, so one of the problems in commercial real estate is that it's a very slow moving market. And if you lease that space up now at a below market rate, it's going to be below market for 10 years. So landlords have an incentive to keep the rate high in anticipation of someone eventually paying that rate. And when they underwrote that loan for that space, their hands are tied. They can't just lease it up at whatever the market is. They need to keep it to what their pro forma was, because if they are below it, then they're locking in that loss for the next 10 years. It lowers their net operating income, and that lowers the value of the building. So when you're selling a building, even a pro forma cap rate based upon numbers in a spreadsheet is more positive than a below actual tenant. So fake money is more valuable than real money to a potential buyer. And now we're in a situation where people are going to have to adjust that fake money pro forma thing and kind of get back to in-place rents.
So there's a sophisticated way of answering why your $1.50 proposal on a $3 building doesn't get a response.
They have no incentive to lease it up. You might be able to get 6 months free or change other terms of the deal, but the rent is usually non-negotiable.
And it's also, different owners have different hurdles and different kind of levers that are important to them.
Yeah.
Irvine Company is going to have a different hurdle and or a different structure than an entrepreneurial one-off ownership group. Different groups will have things that are important to them and different levels that they can pull.
And once you lower that space in your building, that's the last comparable sale. It's the last comparable deal. And so everyone's going to benchmark it to that space. Mm-hmm. So by lowering that rent for that one space, you're essentially lowering the rent for all your spaces. And landlords are going to fight that as long as they can. And we'll see if they can remain solvent longer than their pride allows them to.
Right. So that's when a lot of times when all of a sudden you'll see a bump in a rental rate, like on a quoted rate, or an ownership group really looking to pop the starting rent. That's because the building more than likely will be hitting the market.
Yep. You want to lease it up at a high rate right before it hits the market. It makes it a lot easier to sell.
Cool. Thomas is responsible for the beer output. I'm going to let him close us today.
Thanks for having me, Mike. And I just want to say thanks for reposting my articles. They come out usually once a week, once every 2 weeks, kind of covering significant events. Some of the most recent ones are talking about the employment situation for tech companies. That article came out about a month ago, and now it's starting to see traction as Amazon and Microsoft is laying off people. So there's definitely trends out there, and I'm trying to get them before they become popular. So thanks for helping me get the word out.
So give Thomas a follow. You'll be better suited for it. Talk to you soon.